Hello, welcome to Super Return Asia, coming to you from Hong Kong. I'm Sarah Clark, and today we're joined by Apurva Mehta, and the discussion we're having today focuses on co-investment, knowing when to jump in. Thanks for joining us.
Thank you.
Looking at this, co-investment, it's established a solid track record, data and growing in popularity. What's driving this popularity?
I think investors around the globe are looking for ways to, for us, we use it as a way to optimize our returns. I think investors are, when you're committing to a fund, you have blind pool risk, and a co-invest is a way to reduce or eliminate that blind pool. You get access and exposure to a specific deal, and you know what the exit time horizon looks like, and you can underwrite what that risk reward potential is for one deal, versus when you're investing in a fund, you basically you don't know where the manager or the GP is going to be investing, and you have to wait 10 years for liquidity. So a co-investment, I think the investor demand around it is around the fact that you have visibility into all of these different things.
So how do you identify who is the best partner to invest in this kind of this partnership?
Yeah, so for us, we invest in early stage venture capital. We're US focused. As part of our portfolio, it's within our mandate to co-invest. So 30 to 40% of our portfolio is anchored around co-investments. We do that because we want to be able to press some of the winners in our portfolio and have that visibility for liquidity. When we think about co-investments, we're not picking a GP, and we're not filling the top of our primary fund commitment with managers that offer them. We look at co-investments as, again, just a way to press those winners. So when we look at partners, when we think about partners we want to co-invest with, we've given them primary commitment capital. We have gotten to know them over a long time. We understand their underwriting, and they have skin in the game. So we think about it purely as an alignment, and we want to be aligned with those partners.
Yeah, and the key benefits, what are the key benefits of co-investment? Do they provide opportunities, size and exposure?
For us it is, again, the ability to optimize returns. Every single deal we look at on a co-investment side, we are underwriting as a 5 to 10x opportunity, for that specific deal. The secondary benefit is reduction in fees, and that is a big thing that people think about in co-investing. So it reduces our overall portfolio's fees when you're not paying a management fee on co-investment. And then the last benefit of it is, again, liquidity and reducing the J curve. And so if we're investing in a company that is 5 or 6 years old, that means that there's an exit time horizon of 3 to 5 years from now. And so, where venture capital is a very long tail asset class, and you're not going to see liquidity for 10 years potentially, when you're co-investing in a company that's 6 years old, we can reduce that J curve and give investors capital back sooner. And so I think LPs in general are looking at co-investments in a similar way, same way we've built it into our portfolio.
So seeking your insight, what are some of the pitfalls to look out for when before you jump in, or before the partnerships are jumped in?
I think the biggest thing is that alignment. And so, understanding, again, because we're co-investing with GPs where we have primary capital, there is an alignment. They're in the deals, they're in the co-investments. We did a co-investment where we weren't a primary investor, and there's less transparency. And so again, that having that primary commitment or primary capital with the GP, provides a better alignment. You have transparency into, the ongoing sort of management of that company and that investment.
What are the best performance indicators to look out for before you jump into a co-investment partnership?
Yeah, so it depends. Look, when for venture companies, we're looking at company metrics. So we're investing at the seed stage, through a fund. As that company matures, you can understand things like, what does customer acquisition cost look like? What are revenue metrics? What is the cash burn of a company? So there's lots of metrics on an individual deal by deal basis that you can look at. at the time of exit, multiple and IRR are really going to drive, the performance in terms of assessing if it was a good investment or not. It's going to be based on the multiple and the IRR, but ultimately it's really, did it fit in your framework, in your underwriting framework? So, did it hit your, your metrics of low case base, or high, and really that iterative process of making sure that you're assessing all of these factors, when you go into the next one.
Are there perceived disadvantages by handing over kind of co-investment rights to investors in this particular case? And if so, what are they?
As far as disadvantages, there are perceived disadvantages in terms of, again, if you're filling the top of your funnel with GPs that only offer co-invest, you potentially are missing out on funds that, do not have co-investment opportunities. So I think, from a disadvantages perspective, I think, excluding managers that don't offer them is a common disadvantage that, people will say, like, they only are looking at managers that offer co-invest. And then for us, we offer our co-investment, opportunities to our partners as well. Again, it's having that transparency, knowing that people can execute. The disadvantage can be, if we say yes to a co-investment and you can't actually end up coming up with the capital from your underlying partners, that's where you potentially can run into an issue.
Okay, look, the last question, and it's a big picture question. What are the trends of 2019 that you see with regards to co-investment or the future of co-investment deals?
So look, I think it's early. I mean, people have been investing in private equity for a very long time. This trend on co-investing started, maybe 5 to 10 years ago, 5 years ago. And so I think, there's lots of statistics by data providers on how private equity performs or venture capital performs. I don't think we haven't yet seen a lot of statistics on co-investments, and so it'll be interesting over the next few years to start seeing how that materializes and if that informs people's decisions differently about them. But I think the trend is going to continue again because of that transparency and the visibility and the ability to reduce the J curve and reduce fees. I think you're going to see more and more investors spending time on it.
Apurva Mehta, thank you very much for joining us.
Thank you.
Thank you for joining us. So you can watch more of our conversations and join into the topics discussed at Super Return Asia by following Twitter. Just look for #SRAsia. Thanks for joining us.